This episode is brought to you by Newline by Fifth Third. Drive your fintech forward with the embedded finance platform designed for enterprise fintech and backed by a leading financial institution. Discover how Newline can transform your business at newline53.com. Hello, and welcome back to another episode of the Fintech Takes podcast. This is Fintech Recap because it is now June, and as we do at the beginning of every month, I like to have the one and only Jason Mikula join me to break down the last month or so of fintech news. This one was recorded on the road. I was in New York last week at the StableCon conference, which is a stablecoin-focused conference put on by my friends at This Week in Fintech. So Jason and I managed to hop on the line to break down what's been happening in fintech recently. We talked about Chime and its plans to go public. We asked some very fundamental questions about Chime, its business model, what the company is in its heart of hearts, a bank, a technology company, something else. We also talk about open banking, which, as you likely know, if you've been keeping up with the newsletter, is a subject of much drama and much regulatory angst at the moment. And then, because stablecoins were on my brain, given that I was in New York, we talk a little bit about stablecoins. I think it's safe to say that Jason and I have more questions than we have answers about stablecoins at the moment. And then, as is our habit, we wrap up with a few news stories we can't let go of, including, for me, a question that I never really thought to ask, which is it still implicit if you say it out loud? So all of that and more in this episode of Fintech Recap, which I can't wait for you to hear. So without further ado. All right, Jason Mikula is here. Mr. Mikula, how are you, sir?
I am good. I have been consistently at home in my own house for like weeks now, so I'm recharged and ready for Money 2020 Amsterdam, which should be already happening by the time this comes out. So I'm looking forward to seeing my European fintech crew.
I'm jealous that you have a European fintech crew. I'm still so insular and focused on America first, I suppose you could say, here at Fintech Takes. No, that's a joke. That's a joke to all my international listeners and friends and newsletters. I actually do really want to go to Money 2020 Amsterdam. Every time I talk to you or others about it, they're like, it's nice. You actually get to go outside. There's canals. It's very relaxed. It's a little smaller. It sounds incredible, to be honest with you.
And if you're lucky and the weather is cooperative, they do a really nice, I forget which evening it is, but they do, or at least in the past they've done, I forget what they call it, but Money Fest street party. Ooh. And there's a whole street of bars and restaurants that I guess it's still open to the public, but then if you're Money 2020, you can go in and get certain drinks or whatever the bars are, and it's outdoors. You're not under the artificial light of the Venetian. There are real canals, not fake canals. So yeah, it is a wildly different experience. You will need to make it out next year.
I will do it. Yeah, just as soon as I can jump across the pond without getting in too much trouble with my wife for leaving her with the kids. Then that's whatever age that is. I'm not sure when that will happen, but whenever that happens, I will be over for Money 2020 Europe. I also will, I guess by the time folks are listening to this, have been back from StableCon, but I am actually on the road right now in beautiful, slightly overcast and rainy, actually, New York City, where Nick Milanovic and our friends at This Week in Fintech are putting on StableCon, which is the stablecoin conference to be at. So, Jason, I know we're going to talk about this later in the episode, but very much a hot topic these days, as I know you know, and I think you and I are roughly in the same place in terms of probably being more in learning mode than we are in being an expert on this subject mode. So I hilariously had the opportunity to moderate a panel with a bunch of lawyers and ex-regulators on the shifting regulatory sands of stablecoins. So I can report back once we get to that stage of the episode.
Should we get started with our first one?
I think that we should. Please go ahead. Take us in.
Surprise, the IPO window is open after all. After Liberation Day, which I still can't quite say that with a straight face because we actually have a Liberation Day in the Netherlands when we were freed from Nazi occupation. But that notwithstanding, there were a slew of IPOs, including some specific fintech and crypto IPOs that were looked on track. Then Liberation Day happened. Then everyone was like kind of freaked out and paused. And then a week and a half, 2 weeks ago, it was actually literally my birthday, and I'm getting text messages that Chime S-1 has dropped while I'm trying to enjoy a steak and nice glass of red wine. So obviously, and sadly, I'm not kidding, came home to like quickly at least scroll through the S1. I think our conversation will probably focus on that, but eToro, which is a brokerage and crypto trading app, did IPO pricing above its range at $52 per share and was reportedly 10 times oversubscribed. Circle, the issuer of the USDC stablecoin, is looking to IPO at a $6.7 billion valuation, though this is a decline from its failed SPAC attempt in 2022, which would have valued it around $9 billion. And of course, now, at least as of the time we're recording this, Chime has filed its S1, which we'll be discussing, has not yet priced, so we don't know sort of what the valuation is, and of course has not yet started trading. So I am going to run through some of the key metrics. Obviously, it is a very long document, so we are not going to narrate all of it. And then we can chat about it. We both wrote about it, which is legally required as a fintech commentator. Totally. I did really enjoy your framing as Chime as a Rorschach test. Also very crafty because it allowed you to avoid expressing an identifiable opinion that actually belonged to you. So we're gonna try to avoid any nasty calls from the Chime PR team. So we're gonna try to nail you down. But as far as like key high level metrics, 8.6 million active users. Active being defined basically as doing one or more money movement transaction per month. So that could be a debit card swipe. It could be a direct deposit. It could be using, SpotMe or one of the other kind of credit type products. So 8.6 million active. I will note that I forget, it was probably about a year ago, Shevlin from Cornerstone had survey research, which I think at the time everyone was like a little bit surprised by, that based on that survey research, had a number that was like 38 million Chime users, plus or minus, with a caveat, trying to reconcile these two, being presumably that definition between active and maybe people who've churned or have a dormant account. And we can talk through, some of that as we discuss this. 67% using Chime as their quote unquote primary account, which I know you flagged this in your write-up. Primary being defined as 15 or more like debit transactions per month, or one qualifying direct deposit of $200 or more. The number that I obviously latched onto as the former fintech marketing person, that over the course of the time covered by the S1 reporting, which was 2022 through the end of Q1 2025, $1.53 billion spent on sales and marketing. And I did get a little bit of pushback when, I forget, it's on LinkedIn or Twitter, about that metric, given that is what I'm going to refer to as like the all-in sales and marketing spend line item in the P&L, which includes things like employee salaries, share-based compensation to those employees. So it is sort of a fully loaded number that includes personnel. According to Chime, they calculate their cost of customer acquisition, which I believe is active customer, at $109 or $91 excluding brand marketing spend. And then an RPAM, average revenue per active member, RPAM, or most people would just say ARPU, of $251 in Q1 so the most recent data point. And looking at that CAC number, people will typically talk about CAC versus LTV. There isn't a specifically, at least I didn't notice, and I did Command F and did not find it. There's not a specific lifetime value metric broken out, but there is a decent amount of discussion about things like payback periods and transaction profitability. So the 2022 cohorts had a payback period, meaning the amount of time it took to earn back what Chime had spent acquiring those users, of approximately 7 quarters or 21 months. Which, at least based on my frame of reference back in like lending days, I would view as like a relatively long payback period. So the reason why you care about that metric is it's how quickly, if I spent $109 to acquire this customer, how quickly do I earn back that money so I can spend it to acquire another customer? Right. So shorter, obviously, is better, sort of higher velocity of capital. I swear I'm almost done. Top line rev, 1.67 billion, 76% of which was derived from interchange. I didn't see a breakdown of debit versus credit or charge card interchange in the S1, but it feels safe to assume that that's predominantly debit.
Yeah, I think I saw something to the effect of credit interchange is growing as a share and is an area where they're trying to lean, obviously, because you make more money on credit card interchange, which is their credit builder card. So they are seeing that as a growth lever for revenue. And I guess you could say in some senses it diversifies your revenue because it's credit interchange as opposed to debit interchange, which I'm sure we'll talk a little bit more about. But yeah, that is a percentage is going up as what I recall.
And that makes sense. I mean, they launched that product, the credit builder product, significantly later, obviously, than their core debit offering. Last stat, and then we'll discuss net income, $25 million loss in 2024, but a $13 million profit in Q1 2025. I will also admit I didn't parse through, didn't have the time or did not find the information about sort of like any sort of seasonal trends, because I did notice that Q1 2024 was also profitable. So like over the course of 2025, it's not clear to me that they're necessarily on track for a profitable year, full year, just because of that first quarter being profitable. So Alex, I mean, my $10 billion question, as it were, what is Chime? They definitely went out of their way to sort of say we're not a bank. And I think the implication for quite a while has been that they don't want to become a bank. They don't want to sort of, not to draw Vero into it already, but sort of pursue that path of like getting a bank charter. And they do describe themselves as a technology company. After reading this S1 and discussing with people smarter than I am, what is Chime? What are we describing this as?
Well, that is the $10 billion question, as you say. I mean, I think the biggest thing that's interesting to me about this question, because it really sits at the heart of this IPO and the whole sort of question of how you value Chime. I think from my vantage point, it's interesting. Chime has actually gotten in trouble with regulators for pretending to be a bank when it wasn't a bank, right? So like using the wrong language on its website and make it clear that you're a technology company, you're not a bank. With that, the reason that's funny is Chime has also very famously tried to position itself to investors as a technology company, not a bank. So even though they got in trouble for maybe potentially misleading customers as to if they're a bank or not, Chime, I think, has never really wanted to, in any sense, give the notion to the investors in the public market, certainly, and even private market investors, that they are a bank. They want to be valued as a technology company. Now, of course, when they were raising a lot of their capital, they were raising at a time where the whole idea, and you referenced SPACs earlier, was to go public and to try to capture the sort of tech multiple that was available to companies and really not be tagged as a bank. And we saw SoFi do that. We saw a whole number of different fintech companies do that with more or less success over the last 5 years.
Lending Club, on Deck. I mean, they were very successful at telling that story until they hit public markets.
Right. And the story of public markets is that public market investors are not dumb, I think, right? And I criticize the stock market as a global force for being dumb and for mispricing things at certain times. But like individual investors that study this stuff on a daily basis, like they're not going to be fooled, right? And what we've seen with fintech companies that go public over and over and over again is if it looks like a bank and walks like a bank, they're going to value it as a bank. And traditionally, fintech companies don't stack up particularly well when they're measured as a bank because I think on the one hand, they don't necessarily get the same sort of benefits or same sort of benefit of the doubt on advantages they might have over a bank in terms of, overhead costs and efficiency and automation. Like, I don't know that they necessarily always reap the benefits from investors that are trained to think about these things as banks. And then they get punished because they don't have a lot of the product lines or pools of revenue that a bank traditionally has. Right now, what's interesting, if you dig into the S1 for Chime, and I know you saw this as well, is the Chime runs at this question pretty directly in the S1. And what they talk about is this notion that the traditional business model in banking, which is built around net interest margin, right? The difference between what you pay out to depositors and what you get paid by borrowers that you lend to, that model, which is dominant in banking, is not a good model, Chime argues, for serving lower income or what they call a lot of times in the S1, like everyday Americans, right? And traditionally, they've defined that market as being consumers who make less than $100,000 a year in salary and income. And I think that is a really interesting argument because what they essentially sort of define themselves as, if I could double click into the technology point a little bit, if you look at the S1, they don't even really, I mean, they do in broad strokes say they're a technology company, but really when they talk about their business model, they say we're a payments company, right? That's what they say. They say we are a payments company. And what they mean by that is asset light, right? So they don't have a lot of like these expensive assets. Their balance sheet is very sort of asset light, very efficient. And it's transactional. And so they make most of their money transactionally. Now, that has been a source of a great deal of, I think, dismay or pessimism from people who come from more of the traditional bank world, right? So this is Chime is just one gigantic Durbin exempt debit interchange business. And you can't survive long as that. That's, I think, kind of the pessimist or the banker viewpoint on Chime. But I was honestly, Jason, very surprised in the S1 that Chime didn't try to dismiss that notion or run away from it or kind of hint like, oh yeah, over time we might become more like a bank or we might do more lending or we might, someday get a bank charter. Like there was none of that. They very much said, we think we have the right model, the right sort of efficient balance sheet structure. And we want to continue to run more volume through that. And we think we can. And we think we can create stickier member relationships. We think we can spend less money on marketing over time, to your point. And we think we can just drive more volume through this business model without ever having to become a bank. And they didn't like explicitly rule that out in the S1, but there were no hints that they have any interest in pursuing a business model other than the one they have. Even though they all have gotten into lending, there's indications that they're going to expand into lending. They're going to expand their product set, but they want to be a sort of asset light, payments heavy, transactionally focused business. They don't want to be a bank, which I found fascinating.
Yeah, I mean, I think given the business that they're in and the customer segment that they're currently serving, I do think that makes sense, right? I mean, the fintechs that we've seen become banks, and I'm sure you and I have talked about this. I definitely talked about it with Michelle from Claros recently. It's like the fintechs that have become banks where it has been the most accretive to the business model are the ones that do lending.
They started with lending, right?
Yeah. So they have a more sort of stable, defensible cost of funds. With Vero, becoming a bank, like I continue to argue that it hasn't been accretive to their business model as demonstrated by the performance that we've seen. Right. So, perhaps the Chime customer is a bit distinct than that Vero customer. That's not entirely clear to me based on the S1, but it's lacking some points of comparison that I would have liked to have seen. So sort of like total deposits divided by like number of active users, for example. But, I do think that the positioning of something that is not a bank, and I think payments company is probably a more accurate, more realistic framing than saying technology company, and perhaps a bit friendlier than saying marketing company or brand.
Right.
I do think is fair. I mean, something, and I'm curious to get your take on this. I think Chime has done a great job of serving customers who would historically be poorly served by your money center banks for all the reasons that Chime got started: NSF, overdraft, and whatnot. In their S1, they state quite directly they want to move up market. And I think you hinted at this question in your write-up, which was, why would somebody, whether it's an individual household who's making $150,000, $200,000 and they're banking at Chase or Wells Fargo or Capital One today, why would they move to Chime?
That is exactly the question, probably what the motorcycle driving by was curious about as they drove by your apartment. I totally agree. I mean, I think that question about, and this is actually a question that our friend Jev at Popular FinTech posed to me when we were sort of debating Chime's numbers a little bit and kind of talking about the business. The question really is, like, we'll just pick on Chase. Chase has 40 million plus deposit customers, right? Retail consumer deposit customers, which is a lot more than 8 million. The question is, why don't those 40 million go to Chime, right? Like, what is it that Chase does that Chime doesn't do that, Chime, because I mean, like, those customers would want like no overdraft fees, right? They would want, a higher credit score. They would want early access to their paycheck, right? Like there's nothing about what Chime offers fundamentally that should turn off those customers or drive them away. And Chime has certainly spent a lot of money, to our earlier discussion, trying to build awareness among customers. I mean, it's not like people only under $100,000 a year in salary watch the Dallas Mavericks play basketball, right? Like they're marketing broadly to the entire US population. And so I do think, and Chime talked a little bit about this in their S1 about their plans to expand, right? So we're going to, increase our addressable market by changing the sort of cutoff that we aim at from under 100,000 to under 200,000. So we're going to add this additional addressable market. And they talk about the fact that in order to serve that expanded market, we're going to have to add products that we don't have today, right? So they explicitly talk about adding wealth management and investing, which they haven't really done. They talk about adding a credit card, like not a credit builder card that, cheats their way into credit interchange, but like an actual honest to goodness credit card. They talk about installment lending. I could see them potentially getting into like auto lending. And so there's a lot of areas where I think they will need to expand, because the reality is, I think it's kind of a push-pull thing, right? The experience of someone who doesn't make very much money working with a money center bank is bad enough to push those people to Chime. And so all Chime has to sort of do is counterposition, hey, we're not them, we're something different, you should try us. And I think the point you and I have both been making is Chime's really good at that, right? Like they've built a great product set for that customer who is disaffected by working with big money center banks. Moving from 100,000 to 200,000, though, requires taking customers away from money center banks. And that is less about, I feel disaffected or frustrated with my bank. The like dirty secret of banking is most customers like their banks and are satisfied with their banks. Like I know like everyone hates their bank is a big like talking point. That's not actually true. Like if you look at the survey data, most people most of the time are happy with the bank they work with, which is why most people don't switch banks very often.
They don't hate their bank enough to go through the pain of switching to a new one.
Correct. Yeah, I mean it's more akin to and my wife doesn't listen to the podcast, so I won't get in trouble for this analogy, but it's kind of like a marriage, right? Where it's like, do I get frustrated with my spouse? Yes. Am I anywhere close to wanting to divorce my spouse? No, right? Like everyone sort of sits on this like relationship continuum somewhere. And to just be clear, my wife and I are very much on the good side of that continuum. So just to be totally clear, but like even if you're like kind of like frustrated or annoyed or whatever, like most people don't break up with their banks. It's a hassle. They don't want to, even if we don't really live in a branch dominated world the way that we used to. And I want to circle back to branches because I think this actually is important. Even in a non-branch centric world, people just don't like to switch. There's inertia that sort of sits there. And so I think the real interesting question is, and I'll just use one product that Chime mentioned in their S1 as an example. All right, you want to launch a credit card. Okay, guess what? The credit card space for consumers that make between $100,000 and $200,000 a year, I've compared it before to like every day you wake up in the prison yard and you have to get into a knife fight and you have to survive. Like, it is a brutally competitive business with huge competitors who will take absolutely no mercy on you and who will bring a great deal of sophistication and resources to the table to win, let's be honest, pretty mercenary customers, right? Like, I mean, shout out to our friend Kia. There are a lot of people out there that shop for credit cards, not with like vague notions of brand loyalty or affinity in their brains. They shop based on rewards, and they shop based on like rate of rewards and categories of rewards. And so competing in some of these product categories, if you want to take primary relationships away from these money center banks in this new strata that you're targeting, you're going to have to take away, not just sort of gather the disaffected masses who money center banking wasn't a good fit for.
So, I think you're, absolutely right about the challenges on the product side. I mean, Chime itself acknowledges that in the S1 as saying, okay, if we want to serve this audience, we need a different broader set of products. The first thing that occurred to me is exactly what you just walked through, which is, hey, if you're trying to win that person who's making $150K, they're probably not spending on their debit card. They're spending on a credit card for rewards, whether they're a transactor or a revolver. So it's like, you need to be able to build an offering that's actually going to be compelling for that person, which is extremely difficult, especially as a first-time issuer. And then this is a little bit more intangible, and I'll admit I have not fully thought through this. I also think there's a brand component, right? Like, you mentioned branches. Not that I think most Americans frequently have need to go into a branch, although I do think there is a certain, intangible trust, safety, and security component to like, it's Chase. If something goes wrong, I'm going to be able to get a hold of them. Even if I have to walk down the block and like go into a branch, like, I know I will be able to get a hold of somebody if I need to. Doesn't necessarily mean you're going to get the outcome you want, but it's a different story. I do wonder to what extent, a company like Chime, and this certainly is not a challenge only for them. I mean, Vero has struggled with the same thing, Dave, Moneyline, etc. I wonder to what extent, if you are starting out by serving, this sort of lower income segment of the market, lower credit score, how challenging is it from a brand perspective to move up market and say, hey, we're competing against Chase Sapphire Reserve, American Express. And I know that not everyone makes purchases or selects a financial product based on that, but I do think there's an intangible there that they will need to navigate if they want to win those customers. And to your point, win them from a financial service provider that maybe they're not in love with, but it's like, it's ticking the boxes. And like, do you really want to deal with like moving, switching cards, switching bank accounts, updating your direct deposit, whatever?
No, I completely agree with you. I think that's exactly right. And to build on your brand point, a thing I want more information on and I want to understand better is this notion of like a primary account, right? Because Chime talks about that in the S1. Obviously, they define sort of a primary financial relationship as one where their members have 15 or more credit or debit card transactions with them in a month, or at least one qualifying deposit, direct deposit of $200 or more. I would love to know, if you look at like Chase's 40 million plus deposit customers, how does that break out between primary and not? And how does Chase define primary or not? Because as I was thinking about those numbers and kind of pressure testing them in my head, they sound good. But like the reality is, and I wrote about this in my piece, most people make way more than 15 debit or credit card transactions in a month. Most people direct deposit a lot more money on a monthly basis than $200 a month. Even people who make less than $100,000 a year, they're depositing a lot more in their bank account than plus 200. we don't know how the actual numbers break down across Chime's active member base. But when companies draw lines in specific places, like our cutoff for this definition is $15 and $200 a month, that suggests to me that they're being, if they're smart, strategic about where they're drawing that line in order to like give you this idea. Oh my gosh, look how many people treat Chime as their primary bank account. And, I wonder how true that actually is relative to the type of stickiness that you might have with a Chase or someone like that. And, the point to add on to that is the more products you offer, the stickier you are and the more concentrated you can make, the value proposition of just doing everything with one provider, right? And so if you're a Chase customer, you benefit from a whole bunch of things, including, by the way, access to short-term lending as an alternative to overdraft that Chase very subtly offers to its deposit customers without advertising it broadly, right? And so like there are benefits you get to being a Chase customer. There's access to wealth management and investing. There's preferable pricing on auto loans, on mortgages. Like there's a whole set of things that sort of wrap around small businesses. If you want to start a small business, you can also do that at Chase. And so like there is a stronger reason perhaps to be even more of a primary member than the way that Chime defines it because of the breadth of offerings and because of that brand association and trust. And I wonder with Chime, it's obviously early in their journey towards adding more products and being more of a multi-product company. So it's probably a little too early to say, but I'll be curious to see if we get any indications of Chime becoming even more entrenched as a primary financial services provider than the way they position themselves in the S1 today.
So, I mean, one last thought, and any response you may have, and then I promise we can move on to the next thing. So, I mean, in that same vein, and things I would want to see comps on that I don't think are generally metrics that sort of other banks or bank-like companies put out. Chime in the S1 mentioned that something along the lines of, for a given cohort of customers that it acquires, 50% of them will still be using it at the end of year one.
Right.
And then from that point, the retention rate is like 90% or like 10% per year churn after that. I'd be very curious to see, frankly, I don't know if that's good or not.
Sure.
I don't have any real clear frame of reference in my head if like year one retention of 50% is sort of, to be expected, outperform, underperform. One reaction I did have to that stat is that, fintech loves to make things frictionless, but the counterpoint to making things frictionless is it's very easy to sign up, play with it for a couple weeks and then stop using it. Yeah. Particularly if there are referral bonuses involved, which Chime historically has used referral bonuses. And so, the analogy that I got also some pushback on, I think on Twitter for using was, spending marketing dollars to fill up this like leaking bucket. Like I'd be really interested to see, if and when Chime sort of turns down that marketing spend, what happens to their user metrics? Do they have sort of good retention and good profitability, even as they either on an absolute or like proportional basis reduce their marketing spend? And I suppose time will tell on that one.
Yeah, I'm glad you mentioned that. Just the last point to add on that, because I think that's spot on, is I think that we sometimes kind of confuse growth with profitable growth in financial services, in fintech, because it's a VC thing, right? Like VCs want to see top line growth. They don't give a shit about profitability historically. I think the challenge, though, particularly as you get into lending and not just deposits, but even in deposits is, banks sort of intuitively understand it is actually a waste of money in every sense of the word to acquire the wrong customer, because it just costs us more money to deal with them later, right? And that is not at all how VC-backed fintech companies have been trained to think. But if you go back, wind the clock back a few years, Chime has historically had a horrific first-party fraud problem, right? They have a ton of, let's be honest, shitty members who do shitty things that cause Chime's debit card to not be accepted when you want to rent a car or reserve a hotel room, which is bad for all Chime members, right? And so like there is a cost to growing if you are growing by acquiring the wrong customers. And by contrast, you can laugh about building branches or some of the more historical approaches to acquiring customers in banking. But there is an argument to be made that by doing that, you are sort of signaling to the right customer that you want to work with them, and you're driving positive selection for your business. And a thing I worry about with Chime is not just can they acquire and be more efficient in acquiring active members, but can they acquire active good members who want to consolidate more of their financial life on Chime? And again, for as much credit as I give Chime for building a great base product and doing it really responsibly, right? Like I want to be very clear. I'm always disappointed by consumer fintech companies because they succumb to temptation to add crypto or to do something like Robinhood is just driving me out of my mind these days. Chime never does that. They move slow, they're deliberate, they're very member-centric. So like kudos to Chime in terms of the way they've built their product and their business. But I think jumping up to this next level, it requires a different set of skills and a different way of thinking that they just haven't really had to do so far. So I think to cap off your point, time will tell in terms of what we see for their next act, but I'm excited to keep observing it.
As am I. Do you want to give us the update on what's happening with 1033? I know you're my like 1033 guru who I'm on the most text basis with. So I look to you to be my guide.
Well, I appreciate that. I certainly would never try to position myself in the lane of like a Jane Barrett or John Pitts who like actually are experts on this stuff. But sometimes when you talk to John, you get like 2 hours when you meant to get 5 minutes. So I'll give you the 5 minutes, and then that might spur folks to dig in even deeper. So little nudge at John there, who we love. So Russ Vogt, acting director of the CFPB, has indicated to a district court in Kentucky that is currently overseeing a lawsuit that was brought against the CFPB by the Bank Policy Institute, which represents all the big banks. The CFPB has said that they are essentially going to ask the court to vacate the final open banking rule under 1033, saying essentially that the CFPB under Rohit Chopra overstepped their authority in creating the rule, and that it is just sort of by and large overall not lawful and needs to be rescinded.
Looking to grow your fintech with scalable API-enabled payments? Newline by Fifth Third empowers enterprise companies to accept and process payments seamlessly. Effortlessly launch and scale payment, card, and deposit products directly with Fifth Third Bank. Learn more at newline53.com.
This is fascinating because it was not something that was on anyone's bingo card in October when the rule was finalized. It was not something that was even on folks' bingo card when President Trump was elected in November. And we knew that there was going to be a change in leadership at the CFPB. What folks in the ecosystem were prepared for, and candidly, what I think even banks wanted, was for the rule to be reopened and for it to go kind of back through the Administrative Procedures Act process, and basically for changes to be made to the rule to address some of banks' concerns with the rule. It's concerns that were legitimate, right? Things like liability, when there's a data breach or there's some kind of problem, who has to take the loss on that? Risk management, what are banks allowed to do in terms of evaluating the risk of companies that want access to their customers' data, and when and how can they restrict or deny or revoke that access? And then, like a very, very central issue that's kind of crass, but is really important to banks, which is the ability for banks to charge for access to this data and to make some money from open banking, which they have wanted for a long time. And I think candidly, they view it as really unfair that data aggregators are able to charge for access to this data, but the banks that have this data and protect it and create this data really and working with customers can't get access to some revenue from doing that. So there are these things that banks wanted. BPI outlined a lot of those things as essentially like prayers for relief at the end of the lawsuit that they filed 5 minutes after the rule was finalized. And my sense is that the banks, for the most part, there might be a couple exceptions here, but for the most part, if you think about banking as an industry, I think they're kind of like the dog that caught the car here a little bit, where they love to chase after the car and bark at the car and maybe even get close and kind of scare the car, but like they don't actually want to catch the car. If you catch the car, you get run over by the car. And I think what happened here is that the CFPB under acting director Vogt, he basically went further, I think, than the banks ever expected him to, and said, yeah, no, we're just going to vacate the rule and toss it out entirely. What does that mean if that's to happen? And I want to get your take on this, Jason, because I know you've spent some time thinking about this. Personally, I don't think it's good. Now, I want to be clear. There's a very good chance that this doesn't happen because the court has granted the Financial Technology Association, FTA, which is a fintech trade association, they've granted them the right to intervene in this case and to essentially argue the other side of it. So it's not going to happen unilaterally. There was a similar action that the CFPB took in relation to the capping credit card late fees, where the court basically tossed out the rule. That happened in the same manner, but there was no one on the other side of it defending it. In this case, there will be someone arguing the other side. So it's possible it doesn't happen. But if it does, I just think that we are going to revert to a set of market conditions that will be much more chaotic, right? Like one of the things I've heard, and this is purely just like a rumor on the street of New York, so take it for what you will, but I've heard that already some of the data aggregators, some of the big data aggregators are seeing worse performance and worse connection rates than they were a week ago or a month ago. It's just like very, very recent. But if you talk to fintech companies that use these data aggregators, they're reporting like we're having some kind of problems on the performance side, just connecting accounts. And in a lot of cases, I'm hearing that they're looking maybe at Akoya as an alternative because Akoya is the sort of big bank blessed data aggregator where they think there might be less problems. So you can sort of imagine a world in which if the regulation gets vacated and there is no CFPB watching the space and monitoring and making sure that people are playing by the rules, you can imagine a world where the banks say, you know what, we're not going to make this easy. We're going to actually go out of our way to break connections and to make this harder for fintech companies and data aggregators. Or if we make it easy, you have to have a bilateral agreement with us, which might include commercial terms where you pay us for the data in order to get access to it. Otherwise, hey, nice open banking API you have there. It'd be a shame if anything happened to it. So that's the kind of stuff that can happen when you just wipe away the rules entirely. And I think potentially that does benefit certain players, right? So use Chase as an example. Chase was very critical of the open banking rule when it was going through the APA process. They submitted multiple comments. They were very, very critical. They've come out publicly and criticized the rule. So they really don't like it. Part of the benefit that Chase has is they're the biggest, baddest bully in the yard. And so they can kind of get what they want because they always will have leverage and they can always negotiate bilateral agreements. But if you're even a smaller regional bank that really maybe wants open banking, or you don't want to deal with your customers being mad if open banking doesn't work, there's a totally different set of calculations that exist here. And the last thing I'll say, and then I would love to sort of have you pick this apart and tell me where I'm maybe overreacting a bit, because I do spend a lot of time in open banking land. I think this is going to cause, and our friend Matt Janiga at Trustly made this point on Twitter, this is going to cause a revenge of screen scraping, I think, in a lot of ways, because we had been sort of moving off of screen scraping. No one likes screen scraping, but if banks won't play ball or it's difficult to get access to, screen scraping is always sort of an alternative you can fall back on. The thing we didn't have 10 years ago that we have now is generative AI, which is kind of tailor built to build really powerful screen scraping capabilities. And so if banks think they can sort of walk back to the halcyon days of 2015 when they could sort of play whack-a-mole with screen scrapers from a couple data aggregators, I don't think that's the world we're living in anymore. And that's a thing I worry about. And I think banks, if they're forward thinking enough, should be worried about as well. So I don't know, Jason, where would you sort of poke at that or disagree at all?
I have a couple of half-baked thoughts. So I mean, as far as what the banks want, particularly like the largest ones, right? You mentioned, and sort of the conventional wisdom, as I understand it, is like the two big things are ability to charge and limitations on liability, both of which on the surface sound, pretty reasonable. I mean, I got into a bit of a cordial back and forth on a panel at a Nacha event here in Amsterdam a couple weeks ago, specifically about the ability to charge for access to this data. So the other person who's much more familiar with open banking in the European Union and the UK was basically arguing for something akin to interchange, right? It's like, hey, like this costs money to build and maintain this capability. And so if you, data aggregator or you, fintech are consuming it, like you should be paying to maintain that capability. Which on the one hand, like that is a, logical enough argument. The counterpoint I made to him, actually at least two things. One, the statute calls for this to exist. I guess 1033, correct me if I'm wrong, does not specify one way or the other whether it must be free. Like that is something that was sort of formulated as part of the rulemaking process. Yeah. But if we're thinking about, a user leveraging a service like Plaid or MX or Finicity or whatever, like what is actually happening here? It is the secure digital transfer of information that would presumably exist in something like a statement, a credit card statement, a checking account statement. Banks are, by law and regulation, required to produce periodic statements, which I don't believe they are permitted to charge for. I guess you could charge for a paper version of that statement, but of course you can log on and get the PDF.
You can create incentives to move. Yeah.
In this, I don't know if I'm veering too much into like a conceptual world, but it's like, what pieces of my experience as a user should be at no marginal cost to me? So I can initiate ACH transactions. Those cost money to process, but as a user, I'm not bearing directly an incremental per transaction cost. I swipe my debit card. It doesn't cost me money. There is interchange obviously built into that, and we don't need to open up that can of worms. So I guess it's sort of like a conceptual level. Like certainly I understand why the banks want to be able to assess some kind of charge. I can see that one both ways, to be perfectly honest. The liability piece, briefly, I've always had a little bit of agita about what sort of screening and onboarding practices the data aggregators have. And this is, I'll admit, anecdotal. Like I haven't undertaken any sort of like super serious, like thorough analysis. But I love to sleuth on some sketchy fintechs. And there doesn't seem to be any obvious like criteria about what is a company that a data aggregator would not work with. And I do think that at this point, services like Plaid, like Finicity, like MX, they have a certain amount of sort of name brand recognition with consumers, with end users, almost to the point where there is, potentially the ability to engender trust by having that logo or having that login flow on your site. And so from a business standpoint, obviously I understand if you're an aggregator, like whatever, I want to onboard as many clients as I can because it's a volume game. But it does feel like somebody in this chain of custody should have some level of responsibility for screening and doing due diligence on the consumers of this information. And I'm sure that there is some amount of that happening today. So it's not like obvious, scammers using this to just soak up users' data. But it does feel like there remain some potential gaps there. And then, my last point, And Dan Murphy, who was one of the original architects of the 1033 rule, had a very excellent piece in Open Banker on this specific topic. And something that he pointed out was that if the CFPB, when it moves to withdraw this rule or asks the court to invalidate it, if they specifically go along with this idea that the statute, which this is what BPI, the Kentucky bankers, and I think it's Forsh Bank, something like that, are arguing in their lawsuit, or one of the pieces they're arguing in their lawsuit, that the statute, that Dodd-Frank, doesn't specifically reference or authorize third parties getting this data on a consumer's behalf. So it doesn't authorize Plaid to get the data. It authorizes me, Jason, to get the data. And if I'm understanding Dan's argument correctly, if that line of logic is advanced, that could be a very serious problem as far as how the market structure that we have today, whether or not it's even possible to sort of legitimize that in a future new version of this regulation. And, perhaps not surprising, but the estimate that he put, if you just chuck the current rule and start over, is at least 3 years to develop a new rule. And that's on the assumption that you have sort of status quo staffing levels, which I think we know that we do not have.
Yeah, no, that is all exactly right. Dan's piece is brilliant for those who haven't read it yet. And it does do a good job of outlining this idea that, depending on the argument that the court accepts, if they do indeed accept the CFPB's motion to set the rule aside, the argument they accept could actually make future rulemaking challenging, because there is a debate, and I'm not a lawyer, so I won't litigate this myself directly, but there is a legal debate over the sort of exact intention of 1033 in the Dodd-Frank Act, right? What does it mean? What does it call for? What was Congress intending to be built? And depending on your interpretation of that, and obviously everyone involved has a bias to their interpretation, but depending on your interpretation of that, that could mean basically hey, yeah, we created a digital equivalent to statements. So if Alex wants to pull his data directly, he can do that. If Alex wants to download all his bank transaction data and go do something with that, great, he can do that. But to me, I think that's kind of an interesting framing and an interesting argument, because imagine if credit bureaus worked that way, right? Imagine if every time I applied for a loan, I had to go hit my own personal API at the bureaus, download my credit file, and then send it to the lender to then analyze it, right? How much friction are you adding to that process? The value of the credit bureaus and the system that we have is that lenders have a direct API integration where they can originate like that as soon as I apply for a loan. It takes a ton of friction out. It enables commerce. It makes lending work better. The argument for open banking, the way that we sort of have it in the US right now and around the world, is programmatic access to customer data that's permissioned by the customer, but isn't actually directly provided by the customer, but is provided by an agent acting on their behalf. That is the way that this works efficiently. That meets customers' expectations. That meets the expectations of developers who are building products on top of this data access. And so I think reverting that or walking that back or changing that core fundamental assumption, personally, I hope the court doesn't do that, because that would be a massive change in the way that we think about and understand open banking. And just to add one final point on your liability thing, you're exactly right. The liability thing is a huge mess, right? And I actually asked Director Chopra about this when I interviewed him at Money 2020 last year after the rule came out. And he essentially said, the market will sort out liability. And I was like, I don't know that that's true. I don't know that the market will sort this out absent some framework for assigning liability. But you're exactly right. These companies will approach consumers and say, hey, you can get this cool thing if you give us your bank account username and password. I don't really want just anyone asking for that and with no checks or balances or ways to do that, right? I was thinking about this in the context of Zelle and, payment scams. Imagine the scale of open banking scams you could run if you could show to a consumer a sort of Plaid-like looking experience that they could use to connect to their bank account. Well, in the absence of a framework that manages that access and assigns liability somewhere in that value chain, you're going to get sort of just an uncontrolled environment. So the bank's argument was, the current rule as written doesn't do enough to make it clear who has the liability and who has to manage that risk. But my problem is, if you toss out the rule, now we have nothing, right? Like the rule might not have been perfect, but if you toss it out, now we have nothing. Now it really is the Wild West. And so I don't think it's at all out of line to expect that we might see the ratio of like open banking data scams go up significantly over the next couple of years, because in the absence of any of these rules, I don't know how you police this. So that is a huge issue moving forward, whether the rule gets vacated or not.
Should we cap off this episode with some stablecoin talk? Legally mandated, required?
Yeah, well, I mean, I'm in New York. I'm at StableCon, so I feel like I should do this just a tiny bit. Do you want to go first, or do you want me to?
I can give a rundown of sort of where things are, what has happened recently, and then I'd love to hear what chatter you picked up in New York.
Sure.
I mean, I will caveat that I'm still primarily in information gathering mode. I'm always loath to go out with a hot take and then 6 months later realize I'm an idiot.
Not so fun being wrong on the internet.
Yeah. Well, and you and I have been around doing this long enough that we've seen some hype cycles come and go.
Yes.
Web3 still being probably my most favorite.
And NFTs, man,
yeah.
NFTs ruled. I missed that era so much. It was the dumbest of the dumb. I loved it.
Actually, I take that back. Metaverse was the dumbest of the dumb.
You're right.
I mean, that was so.
They renamed their whole company over it. Oh, I forgot about that.
Now I'm getting sidetracked already. When that was a hot thing for like 3 months, and I forget if it was. I think Chase in the U.S. and I think ING maybe here in the Netherlands were like, look, we built out this Metaverse branch experience, and I'm like, what marketing team conned somebody into signing off on this, because this is not.
Yeah.
Anyway, sorry, I'm getting off topic. So Genius bill update. So Genius is the measure in the Senate. It passed a closure vote, which for recovering political science students like me, that is because the Senate still has the filibuster. So you basically have to move to end debate, which requires 60 or more votes. The Senate did move for closure 66 to 32, with 2 people not voting, including 16 Democratic senators voting in favor. So it moves to a full floor debate. The House has already passed its sort of companion version, the Stable Act. And as a side note, the fact that somebody was like, Stable Genius, like that's what we're going to name this, really makes me just despise the timeline that we live in. But it's where we are. House has already passed Stable out of committee, but it has not yet received a full floor vote. For folks who either don't remember or were too young to experience Schoolhouse Rock, if the versions in the House and the Senate are different, which they are, either they both pass their versions and it goes to conference committee, or they work out any revisions to their bills so that they are identical before they vote on them.
My understanding, just so you know, because this just fresh from the conference, it sounds like the House is going to try to standardize on the Genius bill, is the latest that I'm hearing. So the Stable bill will sort of become essentially what the Genius bill is what I have heard.
Got it. And for a fun crossover episode, none other than Senator Dick Durbin from my home state of Illinois, and Republican Senator Roger Marshall are going to attempt to introduce what's essentially the Credit Card Competition Act as an amendment onto the Genius Act, which I assume is probably not going to be successful, but it does make for a very interesting and convoluted time talking about this specific piece of legislation. So I mean, I've been watching this process, admittedly not with as much attention as I wish I could spare, because it is exceedingly complicated. So as I was preparing for our little chat today, I mean, what was I asking myself? I was asking myself, what do different stakeholders in sort of the existing market have to say about this? So I'm like Googling, like, what does the ICBA say? ICBA had what I would characterize as a timid criticism, expressing concern about disintermediation of community banks, potential impact on deposits. The ABA had a statement, which I wouldn't even describe as a critique, but offered some principles that it suggested following, including doing no harm.
Yeah.
Again, highlighting the potential risk of economic impacts from bank disintermediation, and calling for consistently applied regulation, supervision, and enforcement. CSBS, Conference of State Bank Supervisors, expressed concern that Genius undermines the state banking system, both due to federal preemption, so stronger federal preemption than they would like to see, as well as what they describe as a lack of parity between state and federal stablecoin issuer licenses. And then you've had a plethora of sort of consumer advocate critiques coming from different angles, including lack of deposit insurance for stablecoins, what advocates argue are insufficient consumer protections, including that deposit insurance piece. And as always, the boogeyman potential for big tech to become sort of de facto banks by being able to issue and control a payment and sort of pseudo deposit instrument of stable coins. And then there's the entire very distracting but relevant Trump grift angle, which I don't think we even have time to go into. So I know we're limited and we're already over our time already, but what did you hear in New York, and what pieces of these different stakeholder concerns are you paying the most attention to?
Yeah, it's a really good question. So this was the exact topic of the panel that I moderated, which included, among other folks, Elena McWilliams, the former chairman of the FDIC. So pretty interesting group discussion on a lot of these questions. The conference I'm at is very pro stablecoin, as you might imagine. And so I was hearing more of the sort of opposite side of the argument. I think basically this sort of entangles a couple different things, right? Because there are two, I think, concerns that sometimes pretend to be one versus pretend to be the other. One is like, what are the legitimate safety and soundness concerns around any new type of essentially charter, right? Because that's what we're talking about, is a new sort of regulatory framework for a different type of entity that can participate in this financial services activity, right? Which is issuing a payment stablecoin. And payment is important because there are restrictions in the bill on the ability for stablecoins to not be backed by other things besides cash or treasuries, right? So it doesn't allow for like algorithmic stablecoins or stablecoins based on other assets that are maybe slightly riskier. It also currently has pretty strong language, although maybe not as strong as banks would like, restricting stablecoin issuers from offering yield. So really, truly like a payment stablecoin, meaning the equivalent of like an operating account for deposits, not a competitor to a savings account or to a money market fund or to places where you might be trying to generate yield. So they're trying to sort of narrowly define what this thing is, because there's lots of different types of stablecoins. And then once they define what that is, they're basically trying to figure out, how do we sort of split the difference between making sure that we have a safe and sound banking system and that we address all of the legitimate concerns around this. And you referenced like insurance as an example. Insurance is kind of a funny one because on the one hand, you could say, well, if these are all totally 100% reserve backed, why do you need insurance at all, right? Like, what if they just are bankruptcy remote and well titled, and there's sort of very specific language around the order in which different stakeholders are paid out in the case of bankruptcy? Like, doesn't that kind of take care of the problem? Yes, in some senses, because it's not fractional reserve banking, but also no, because as we know, the FDIC is really good at going in over the weekend and making sure that there's no interruption in access to funds. I don't know that we'll have that same like fire department just waiting to like jump off their seats and go put out a fire if one of these stablecoin issuers fails on a Friday. So that's one concern, kind of operationally. And then another concern is more sort of theoretically. people have compared stablecoins to money market funds, which started appearing in the 70s. And even though money market funds are similar in that they hold treasuries or they hold other really sort of stable assets and they're fully backed, there have been runs on money market funds before, right? Like during the great financial crisis, there was a run on money market funds, and the government actually had to step in and create a specific facility to backstop those, to stop the run on money market funds. So panic and financial instability is irrational by its nature. And so it doesn't always look at it and go, oh, well, this is FDIC assured and this isn't. That means we'll treat these differently. Like that doesn't always happen. And so I think those concerns are very valid. The thing that the audience, I think, pushed back on, and the folks on my panel pushed back on, is concerns about safety and soundness, very valid. Concerns about disintermediating or disrupting banks masquerading as safety and soundness concerns, annoying and frustrating and not as legitimate. And so I think the concern that a lot of folks in the stablecoin and crypto community have is banks, the ICBA, or even someone like CSBS, right, the state bank supervisors, they will come in and say, oh, we have objections to this, this, and this. Behind the scenes, they'll push for changes or try to slow things down. And they'll frame their arguments as, we're totally fine with stablecoins, but we want to make sure, they don't do these things. And I think the perspective of the crypto community is that's just window dressing on them saying we don't want to be disrupted. And I do think there is some fairness to this, because like when I wrote a piece all about this, when I look at stablecoins and I kind of play that forward and think about what the world might look like when regulated stablecoins are a part of the ecosystem, I don't see any way for community banks to do well in that future. Like I don't see there is no like Durbin Amendment coming to save community banks as stablecoins enter the market. I just don't see that. And so, will Chase be horribly disintermediated or bothered really at all by stablecoins? Probably not. And in fact, the Wall Street Journal reported that the big banks are already talking through their consortiums like Early Warning Services and the Clearinghouse about maybe issuing their own joint stablecoin, which is like, of course they're going to do that. Of course they're talking about that. That's exactly what big bank consortiums exist to do. And so I think that it's very likely, A, that we are going to see this legislation pass. That seems to be universally considered to be, they've cleared the hurdles, it's going to happen. B, they're going to try to accelerate the rulemaking process, I think, as much as they can. I don't think they're going to dispense with APA and the sort of standard process, but they're going to try to speed run it, I think, as much as they can. And we are going to go into a world where these things exist. And I think, there are some open safety and soundness questions. And I also think that we are going to see pretty significant disruption to certain incumbents in the market. Even, going back to the state bank supervisors, like, shit, I might prefer to have a stable coin than to have a money transmitter license, right? Like these are like kind of legitimate, like door A, door B type questions that get opened up once this becomes a regulated activity. And so that was a lot of the discussion this morning.
Yeah, I mean, something in, if I'm wrong on this, just politely tag me on X.
We'll just edit it out of the podcast so no one can prove it.
Yeah, that's actually a better idea. My understanding is that currently as written, the Genius bill does prohibit issuers from paying yield. But my understanding is it does not prohibit other entities. So for example, today, if you go on Coinbase, you can earn 4.1% rewards on your USDC. Yeah. On Kraken, you can earn 5.5%, and they describe it using the term APY. Sure. You can earn 5.5% APY rewards on your USDC. So on the one hand, like, I do think that there potentially, and there are always unintended consequences, as Dick Durbin should know so well, as far as like how this sort of plays out and impacts the market over time. But you can imagine a world where it's like, oh, well, if I can earn 5%, 5.5% on my USDC, and at least conceptually, it's almost like this narrow bank where at least the stablecoin deposit is, in theory, not runnable or shouldn't be runnable because it's fully reserved. Like, why would I not go and try to earn some yield? I'm assuming that there is risk attached to earning that yield because, at least as I understand the mechanics, and I remain a crypto amateur, not even 2 bits, 1 bit. is that the exchanges are generating that yield by, I think the fancy word they use is rehypothecating, but like lending out your underlying, in this case, USDC. So I mean, at this point, again, I remain reluctant to try to draw too firm of a conclusion, because there's what everyone says could happen. All of those people, almost universally have some agenda of like why they want what they want, because that's how politics works. And then what actually gets passed, what regulations get formulated and implemented to actually sort of like operationalize pieces of the legislation that require that, and then what's the impact on the market. I guess time will tell. I mean, my sense is absolutely that yes, something is going to pass here. What I hope does not happen, but seems entirely possible, is that it becomes like a nice little arbitrage where, doing something in fiat US dollars is hard because rules, but I can just go do it over here in this other thing that's essentially a dollar, but we're going to call it something else. And now I can, at least for a couple of years, get away with like ignoring all of these rules. Which, I mean, I'm pretty cynical at this point. Maybe that is like a legitimate way to drive innovation, with a very big asterisk. Like, we saw what happened in 2022 with crypto. Is this the same thing? Absolutely, it is not the same thing. Like, I want to make clear that I'm not, I don't want to draw like a perfect corollary between, some of the more egregious stuff we saw in, crypto winter and stablecoins. But like, it does pose a number of potential areas of risk, including like, are we going to see some sort of crazy stablecoin collapse in the next 1 to 2 years? Maybe.
It's exactly the right question. And I will say, all of the lawyers and ex-regulators who are on my panel, I asked them, like, what did they want to tell the audience, who were mostly like builders in this space? What did they want to like tell them? All of them said the same thing, which is you absolutely have to hold yourself to a high standard, because we can't undermine trust in this area. They all said a version of that, right? They were like, one bad apple spoils the whole bunch. We can't have another like FTX. We can't have another like Synapse. And so I do think there is this sense on the part of maybe call it the more sort of buttoned up side of the stablecoin market, that they fear a world in which, once you create sort of this regulatory permission structure in this framework, that people will try to jam a whole bunch of stuff through it because it's an easier path to go down, right? And Jason, it reminds me a lot of, we're not making a trip to Bass Island. We're not doing that. But it does remind me a lot of banking as a service like 5 years ago, where it's like, ooh, we could either get a de novo bank charter, I don't like that, or we could go do this Bass thing, and like, we're not going to get asked any hard questions. It's really fast. There's APIs. Like, this is amazing. And now, of course, from a fintech product developer's perspective, we've kind of ruined Bass, because we've like started holding it to the same rules that we should have been holding everything else to. And I worry a little bit that stablecoins are going to become sort of the new Bass, in the sense that, hey, here's this infrastructure. In a broad sense, it's regulated and it's something that you can like build on and trust. But the rules as they're enforced are pretty loose. Like, I think we're going to absolutely see massive AML problems as it relates to stuff built on stablecoins once this new framework is in place. Like, I think we're going to see a lot of that. And, I think the question is just, how much of that is the industry going to tolerate? How much of that are VCs going to sort of subtly or not so subtly encourage? And then, depending on what happens, like, what is the backlash, right? Because the point the folks on my panel were making is, every time we do this, every time we screw this up and sort of press our advantage too far, we create a backlash. And, they spent a good amount of time at this event this morning bitching about the regulatory environment over the last 4 years. But the folks on my panel made the point, like, it was the industry's screw up that created the space for that regulatory environment to exist over the last 4 years. And so I think the hope with stablecoins is, maybe we can chart a more moderate path that avoids some of the sort of negative backswing that could happen. But I don't know that anyone feels super duper confident in that, because, as you said earlier, you and I have just been alive too long to really be too optimistic about that.
Yeah, I mean, if past is prologue, something will blow up, but it will not be the thing that we expect.
Correct. It'll be just different enough that we won't see it coming, but then in retrospect, it'll look totally obvious.
Should we can't let it go? Get you on with your day?
Yes, I gotta get back because actually our friend Rohit Chopra is speaking in a little bit, so I'm gonna hustle back to the event. But before we do that, what do you got for me?
Okay, this is loosely related because it is a crypto kidnapping made for Law and Order. I don't know if we've ever talked that I'm like a diehard Law and Order Special Victims.
I don't think we have talked about that. Okay,
I mean, this is like, they're on like season 25, so obviously I've been watching it for a while. Yeah. But there was a absolutely batshit crazy story in the New York Times. I'm sure it was covered elsewhere as well, about a Italian guy who was, well, I guess he went into the apartment or townhouse willingly for some kind of business meeting, but then he was, quote, subjected to weeks of torture, which included beating him, shocking him with electric wires, hitting him with a gun, and pointing the gun at his head, end quote. And at one point, they threatened to throw him off the roof of this 5-story house if he did not give up the ability to access his crypto. Which, on the one hand, like, I know that these kind of things, this is not necessarily the first time something like this has happened. I did concurrently see a tweet from Caitlin Long at Custodia, who was out at whatever Bitcoin conference is happening in Vegas. And I mean, I shouldn't laugh because I know it's serious, but it was like, don't scan QR codes.
Yeah,
like,
don't use
leave your
public
drink unattended.
Yeah, I saw that.
Don't use public Wi-Fi. And I'm like, wow, like, I've been to a lot of, I travel a lot generally, and I've been to a lot of fintech conferences, and I've never been worried about getting drugged or kidnapped. But I guess if you're self-custodying, potentially a lot of money, that is probably something to be aware of. So that is what I can't let go of this month.
I saw that story. There was a little detail in it that the house that he got kidnapped in and held in had 2 butlers. Did you see that part? 2 butlers.
Yeah, I did see that. I was curious. Did the butlers knew this was happening?
That's my question.
Like, just went along with
That's
it?
my question. Like, apparently
I need more information. I need more information about the butlers.
The article was saying something like they're being questioned. I'm like, yeah, I would question them who were in the house when this was happening. Yeah. Like, it's crazy. It makes me think, Jason, that the next era of crypto is going to be defined by a trend that has existed outside of crypto for a long time, which is, you heard the whole like quiet wealth thing, where it's like be rich, but be quiet and subtle about it. Like, wear designer clothes that aren't gaudy and obviously designer clothes, but actually cost a lot of money. And like quiet, subtle wealth is sort of this like trend that needs to come.
You're saying fewer Lambos.
Yes,
Lambos.
That needs to come to crypto, because like, if you are your own bank and people know how much your bank has, you are signing yourself up for things like this. Obviously, like, we don't condone this behavior. This is horrific and bad, and don't do this. But like, the fact that like crypto people have to think about these things and going to a conference and like, might I get kidnapped? Might someone hack my phone? Like, it sounds like a crazy world to live in. I'm glad my crypto assets are very meager, bordering on none. Just to be clear to any listeners, I don't have any crypto. So. Yeah.
What can you not let go of this month?
I actually have one for you that's not crypto, if you can believe that. Normally, I feel like that's always good for a can't let it go. But mine is President Trump's recent Truth Social post, I guess, where he posted that the Federal Housing Finance Agency is planning, and who knows when this will happen, or even if it will happen, given President Trump's sort of spotty track record about actually following through on stuff, that Fannie Mae and Freddie Mac are going to be privatized, which is something that's been speculated about for a while. But in speculating about that, there's always this conversation about like, well, should we privatize them entirely? Should we still kind of make them kind of implicitly guaranteed by the government to make sure people trust them? Like, what should we do? President Trump just went out right and said it. He said, we're going to privatize it, but, quote, the U.S. government will keep its implicit guarantees, end quote. That, as many people pointed out, is not what the word implicit means, and sort of undermines the whole sort of subtle messaging that oftentimes exists with these sort of quasi-private public partnerships, a lot of which exist in financial services. So I guess not shocked that President Trump wasn't able to artfully communicate that nuance, instead rather just saying it out loud. I will also say, having worked at FICO in the past, Bill Pulte, who is the director of the FHFA and is sort of in lockstep with President Trump on all of these initiatives, has also recently been very publicly critical of the FICO score and the sort of alleged price gouging that FICO has been doing in the mortgage score space, and is pushing apparently to reduce the dependence of Fannie Mae and Freddie Mac and lenders that sell to them on the FICO score. And if you want to see, just how important the FICO score is to FICO's business, look at their stock performance recently. Like, it is going down a lot. I joked on Twitter, although also not a joke, that FICO may want to consider buying some Trump coin stat, because if they don't turn this around, things are going to continue to get worse. So lots of fun stuff from the FHFA.
I mean, you can always count on Trump to say the quiet part out loud.
Yes, exactly.
And that when you say implicit guarantee and then you write it down, right, for the whole world to see, I'm not sure it counts as being implicit.
Not so much. Yeah, I think at that point it's not implicit, and now it's Matt Levine had a great take on this about future presidents like being mad that the market thinks that's guaranteed. It's like, oh, because of this Truth Social post back in 2025. So future historians, you're welcome for all the great things we've done for you. Jason, thank you for another episode of Fintech Recap. This was a lot of fun.
See you next time.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.